It goes without saying that the travel industry has been getting its face kicked inside out this year, and Delta is no exception. With a 52-week price range of $17 all the way up to $62, we're currently sitting right about in the middle at $31, $32. Is this a chance to grab a stock that might double in the coming months or quarter? Today we're going to take a look at Delta stock. Welcome back, family. My name is Trey, getting in touch with you from Japan. Today we're going to be looking at Delta and maybe going into the future here, looking at some of the other airlines as well. Take a look here at the 1-year chart. We see in March, like most stocks, kind of got face punched, and we see like a slight kind of recovery kind of going on. Not as low as 17, certainly, which is kind of nice to see. But let's zoom back to the 5-year chart here. And you can see kind of how things were going for many years up until the March decline, when things basically fell off a cliff when travel got shut down. We're going to look at the financials, but before that, we're going to take a look at who they are, how they're positioned in the market, some of the strategies they've been employing to become so big. And one of the really exciting things that we get to see in times like this, when companies with lots of assets have been beaten down so hardcore, is that a lot of times you can find things on sale if you're willing to pick up a little bit of risk. So a few months back, I did a video on American Express. And one of the really interesting things about American Express was that they primarily target business travelers. They're less price sensitive, and they're more likely to be traveling frequently for work. One of the really interesting things we see with Delta is that they're really tied up with American Express, and a lot of Delta's clients are business travelers and therefore repeat customers, and therefore probably less price sensitive. As a result, Delta has a slightly more premium position in the market. Delta's co-branded cards with American Express make up about 1/5 of American Express's loan book, showing how interconnected their business models are. And so I didn't really know that Delta kind of had a more premium position in the marketplace. But interestingly, if we zoom out and look at the entire world, Delta actually is the biggest airline by revenues and by a few other measures as well. Delta is followed really closely by American Airlines, Lufthansa, and United, in that order, who by most measures are pretty close behind Delta, though by some measures at a severe disadvantage. Another strategy that Delta uses to maintain a higher profit margin despite having a smaller staff is by using older planes. This doesn't necessarily stop them from offering a more premium service or a slightly more premium service, but at the same time it can keep especially depreciation loss and depreciation costs lower. And it's also a little bit of a double-edged sword because there are also other expenses associated with having an older fleet. I'll get into that in a moment when we go into some of the challenges, some of the concerns that we might have for Delta going forward. So that's who Delta is. Now let's take a look at some of the financials that they released in their most recent third quarter earnings report. Despite the pandemic and all the shutdowns, they somehow managed $3.1 billion in revenues, which led them to a pre-tax GAAP loss of $6.9 billion. That works out to a per share loss of $8.47. They also highlighted that they ended the third quarter with $21.6 billion in liquidity. And liquidity is important to look at for companies, especially in this kind of scenario, because it means cash, but also things they can quickly turn into cash to pay off debt or to be able to cover expenses that they weren't really expecting. They've boosted that liquidity position in the last quarter to significantly so that they can have a store of cash to carry them through during these hard times where they don't really know exactly when demand is going to start picking up again. They also mentioned that there's been a steady improvement in the cash burn rate. Simply put, the cash burn rate is like how much money you have to be paying every day just to, keep your employees, keep your planes properly suitable for flying and maintained, and also gasoline and all these different expenses. Every day you're making very little money because you can't fly that much, but you still have to pay for all these other things. Their cash burn rate has gotten a lot smaller. The September cash burn rate was about $18 million per day, which has come down significantly from previous months. Previous quarter's cash burn rate was about $43 million per day. And management said that they're expecting to get back to about a zero-ish cash burn rate in the second quarter of 2021. They mentioned in the report that the GAAP loss was this much, and then they mentioned that the adjusted loss was this much. Basically, the difference between those two. One is GAAP, generally accepted accounting practices, which basically is like a set of rules. This is how you do it. This is how you report your numbers so that we can compare apples to apples between all these different companies. But the adjusted one is kind of like management can say, oh, because of the pandemic, we had these special expenses. Let's just ignore those. And sometimes management will be a little bit creative, a little bit tricky with the way they play with the numbers. But generally speaking, I think Delta's management is very like above board. We can trust kind of their way that they're playing with these numbers. They said the adjusted pre-tax loss was only 2.6 billion rather than the GAAP loss of 6.9 billion. The difference here lies in numerous pandemic-related factors, including early retirement packages and fleet-related restructuring. With this math, the per share loss works out to be only $3.30, which is a lot smaller than the GAAP loss, but still larger than a lot of analysts were expecting for the stock. Compared to last year, adjusted revenues were down 79% to $2.6 billion. Capacity was also down 63% compared to last year. Total operating expenses decreased $1 billion, which is good. And that includes the $4 billion of pandemic-related expenses mentioned earlier when I was talking about the adjusted loss getting smaller. It looks like management took really aggressive measures to cut costs so that they could lose less money basically this quarter. On staffing, they lowered their capacity to about 80% of what it was in 2019. And we also found out that about 1/6 of the company's 90,000 employees have opted to take steps towards retirement, and in some cases early retirement as well. So one of the tricky things, especially with big unions, is that you can't just be like, oh, we're not making any money, guys, please just stay home and we're not going to pay you. You can't really do that as a big company. And so one of the things they can do is say, hey, I know you're not quite at retirement age yet, but if you could retire a little bit earlier, we'll help you out. And therefore, lower our continued like everyday cash burn going into the coming years. Obviously, we'll have lower capacity to be able to bring on customers. But one of the tricky things about airlines is that you have these guaranteed expenses moving forward, but you're not really sure when traffic is really going to start picking up substantially going into the future. So these cost-cutting measures on management's behalf, and also the willingness of the employees to take packages like this, has really helped them lower their expenses and therefore kind of getting them in a good position moving forward, even though we don't know when demand is going to start picking back up. One of the really interesting things when looking at airlines is that, as you know, there are miles-based rewards and miles-based flights and things like that, and those are really tricky to factor in because it's kind of free, but it's kind of not. And there are expenses associated with, credit card deals and how much it costs to get a new person to use this much on your credit card so that they can get those miles, so that they can fly this far and stuff like that. And all of these are really hard to calculate. One of the ways they'll split this up is by saying these are revenue-paying passengers and these are not revenue-paying passengers. One of the interesting things in this last quarter is that they nearly tripled revenue-paying passenger flights compared to the previous quarter. So that's a really good sign showing us that we might be kind of, looking forward to a bit brighter future in the coming months and quarters. These cost-cutting measures led to a 52% decrease in operating expenses compared to the same quarter last year. So those are some of the financials to be looking at, and obviously it's a grim picture. But one of the interesting things we're looking at with companies that are just so beaten down like this is how much bang for the buck are we getting? On this channel, we've been doing a lot of tech stocks where it's like PE ratio of 8,000 and things like that. And we're kind of looking at the opposite scenario with this. Everybody's running away from airlines and like cruise lines and things like that, thinking like there's no hope, so I'm out of here. But in this case, because so many people have taken off, the stock prices dropped significantly. And so if we can come in there, grab some stock and maybe sell it in a couple of years for like double the price, that might be a good opportunity if you're willing to take on the risk. So before I share about what I'm going to be doing with Delta, I wanted to share about a couple of other concerns for us to look at before we jump in and buy stocks. So one of the really interesting strategies that Delta employs to maintain a larger profit margin, as I mentioned earlier, is maintaining an older fleet. Now, one of the really tricky things that we've seen during this time is that obviously all the airlines are kind of like, whoa, we don't have any money, so we can't be buying new planes. So there could be like, let's say at the end of next year, there could be a point where all of the airlines are like, oh, we can breathe again. Okay, we got some money going. Hey, Boeing, sell us 10 planes. And if like every airline does that at the same time, Boeing like can't crank out that many planes that quickly. It's a really big project to make a plane. And so it'll be interesting to see like kind of the double-edged sword of having an older fleet. So you know that you need to be spending a little bit more money on maintenance. your flight and your the interiors of the plane and stuff might not be as sexy. Your planes might not be getting as good mileage as some of the competitors, but they've determined that running these older planes basically gives you a larger profit margin in their formula. So one of the things that they'll be needing to take into account is like buying used planes. If they do that, I don't even know if that's a thing, but buying used planes might be harder coming up, might be easier, but also not being able to buy new planes coming up here because of all the demand of all the different carriers might make it so that they have to run really old planes even longer. We'll see how that ends up impacting, and there's no numbers on that. They're not going to come out and be like, oh yeah, all of our planes are going to fall apart or something like that. And I doubt safety is a concern. It's more just kind of like they're probably just going to need to be really flexible with how long they use these planes and how they depreciate them and things like that. So that's one concern just to consider. And the other one obviously is like, when will travel resume? There are different kinds of thoughts about whether leisure travel or business travel are going to resume first. Interestingly, here in Japan, they're talking about probably the borders. Like, you can't even get into Japan if you want to right now. Like, if I went home to America and then tried to come back here, even though I have a house here and a business here, like, it's really, really hard. You have to jump through all these hoops. It's getting easier now, but it sounds like on the Japan side, they're saying, okay, we're going to start slowly letting international business-related travelers back into the country in kind of the first quarter of next year, probably-ish. They haven't talked about leisure travel yet, but it sounds like in the US, they might be taking a different approach. They might be taking a different tack and saying, let's hold off on business travel and let's just let leisure travel be, okay for now. And just like I mentioned in the American Express video, same thing here. Both of these companies are dependent on business travelers and their higher margins and their less cost sensitivity and things like that. And so if business travel ends up remaining difficult for especially longer than leisure travel, that might put Delta in a very tricky situation where other airlines are kind of stealing their thunder. Other airlines might be having an opportunity to, dangle some juicy looking carrots in front of business travelers and say, yeah, you want to come and fly with us instead of Delta. But on the flip side, if business travel is the one that starts operating normally first, Delta might have a really good advantage. So it's hard to say right now at this juncture. Those are just a couple of things to have in your mind if you're thinking about investing going forward into the future here. So what am I going to do with Delta right now? I don't own Delta. I have owned Delta in the past. I haven't spent loads of time looking into all of the different airlines right at this juncture. We know that there have been a couple of other earnings reports recently. So if you're interested in hearing my thoughts or me doing an analysis on another airline, please leave a comment in the comment section below. And again, I haven't compared, like which one is the greatest investment right now at this moment, considering I have X number of dollars or whatever. Generally speaking, I think if you have to invest in an airline and if you're okay holding on to some risk going into the coming quarters, Delta's probably the safest one. I did mention that they're the largest airline. We also mentioned United and American and Lufthansa, and I haven't looked into the details of their current, positions or trajectories. But I think with Delta's position and especially with their liquidity that they've boosted up recently, I feel personally a little bit more comfortable with the way they're running things going forward in the future. It looks like at their current cash burn rate with their current liquidity, they can probably last a couple more years. And that's assuming that the dismal amount of flights and passengers continues going forward. But, if we're talking about maybe February, March, maybe May or June, if things start getting back to normal, or if there's some kind of vaccine or something like that comes out, it'll be really interesting to see what happens with those numbers. Delta's probably in a really good position to be able to, hold that number one position going forward without like insane amounts of risk. But I did want to notice, again, that double-edged sword, boosting that liquidity, they had to take a lot of long-term debt. And their long-term debt has jumped up recently in the past quarter, like significantly. So their long-term debt and capital leases has basically doubled in the last quarter, up to $35 billion. So that's not to say they have so much cash on hand that they could just pay off all of their expenses and be sitting pretty like a tech company or something like that. There's still some risk associated with the company. And all that being said, there's still like a lot of risk and surprisingly not a lot of upside when it comes to airlines. Warren Buffett is famous for being like, I'm never getting airlines. He ended up getting airlines and then losing a bunch of money on them. But basically the consensus is that There's like so many different factors that come into it. There's like world events, there's, pandemics, there's government intervention and control. There's super duper high expenses associated with buying planes and keeping your staff happy. You don't want an upset airline staff, as we've seen in the past. And even when things are going well, it's kind of like 7, 8, 9% gains kind of thing, which is like not super exciting, not super sexy. But right now, while the stock price is depressed, we might be able to get on for a good ride over the next couple of years and then get out of it. You might be able to double your money, and if you put in $1,000, then you'll have 2 in a couple of years. If you can handle that, seeing that $1,000 maybe become $500 or $200 before it goes back up in the coming years, then this might be a good idea to have something in your portfolio like this. And so depending on your investment style, depending on your risk tolerance, are you one of these people who's kind of like, yep, I'm retiring in a couple of years, and so I need to lower my risk like significantly and just be in really big, safe, secure things like Visa and Apple, then probably not the right stock for you. If you're like, okay, just kind of Vegasing, YOLOing it and just being like, here's my $100 or here's my $1,000, let's see what happens. And if it grows, that's cool. And if I lose it, I'm still okay. I'm not going to die. Then this could be an interesting stock to get into, And again, you don't want to be in this forever. This is not something you go and throw like 90% of your portfolio at, hoping that it doubles overnight or something like that. For me personally, I might be okay, putting in like 0.5% or 1% and just being like, let's see where that goes in a couple of years. I'm just going to, not look at that for a little while and see what happens, And my personal investing style is more like, get into the companies that are going to be changing the world and dollar cost average in over the months and years and things like that. Like my cost basis on Tesla stocks is like $60 or something. So I'm the kind of guy who's just kind of buying slowly over the years. And then, once it's doubled or tripled, like Tesla again, like 800% or 900% gains or something insane like that, then I can start dollar cost averaging out. And then maybe I can also keep picking up stocks here and there if I still believe in the long-term vision of the company. I think if I were to get into Delta, it would just be kind of like a couple of years and then get out and start looking back at all the other things that I love, like Square and Tesla and Lemonade and these kinds of stocks. But what do you think? Are you already in Delta? Are you dollar cost averaging up or down? Do you think you're going to be grabbing some now? What do you think? I'd be interested to hear your thoughts down in the comments section. Looking forward very much to having a conversation with you guys down there. Thank you guys so much for watching all the way to the end. I know there are like a lot of YouTube channels out there, but if you stuck around all the way to the end, thank you guys so much for that and for your support. I love you guys very much and have a great day.